Welcome back to the Global Ledger. I'm Justin. In episode 8, we explored shadow banking, the part of the system that creates money-like promises outside the traditional banking system. Today, we zoom in on the engine at the center of that system, and that is the repo market, where I'd like to say modern money is made and in a crisis, very quickly destroyed. Repo is how dealers fund themselves, how treasuries become money-like, how institutions park cash, and how shadow banks create liquidity. So if liquidity is, say, the lifeblood of the markets, we could say that the repo market is the heart. So by the end of this episode, you'll understand what repo actually is and what it isn't, of course. Why it's so central to modern finance, how it creates shadow money, which we've talked about before, and how the Fed now stands behind this market. So let's get into it. So what is repo, really? The word repo is short for repurchase agreement. Here's the basic idea. So one party needs cash, another party has cash, but wants it to be safe and collateralized. They agree to do a temporary swap. Securities today, cash today, then reverse the trade tomorrow or later at a slightly different price. So mechanically, a repo looks like I sell you a treasury today for $100. I agree to buy it back tomorrow for $100 and say 1 cent. That 1 cent difference is the interest, the repo rate. So, but from the view of money, you could say, it's not really a sale. It's a secured loan, cash against collateral. Reversed basically at maturity. So to the cash lender, it feels like a super safe short-term asset, almost like a deposit. So, but to the borrower, it's funding for their balance sheet. So, and that's the core of repo. So, who uses repo and why? Repo is everywhere in modern finance. Borrowers in repo include dealers funding their inventory of treasuries and other securities alike. Hedge funds using leverage would be another. Banks as well, them being able to smooth out their short-term funding needs. And of course, money market funds that sometimes transform collateral. Lenders in repo include money market funds, as well, cash-rich corporations, securities lenders, and some foreign central banks and sovereign funds. And so why do they use repo instead of just borrowing and lending unsecured? Because repo offers safety. It's backed by collateral. It offers flexibility. So overnight or very short term. And often better rates. For big institution, repo is the closest thing to, say, a secured savings account. For dealers and shadow banks, it's the main way they are able to turn securities into funding. So how does repo create this shadow money? Here's where repo crosses from being just a funding tool into something much, much more powerful. Repo liabilities behave like money for institutions. If you are a large cash investor, you lend cash into repo, you receive collateral, plus you receive a promise to be repaid tomorrow. And you can treat that promise as cash-like, because it's short-term and secured by treasuries. So repo creates assets that are safe, liquid, short-term, interest bearing, and readily rollable. I mean, that's a really important thing as well. So that's what deposits are for households. So from the system's perspective, repo is deposit-like money for institutions. That's why we say the repo market is where shadow money is created. So let's talk about some of the terms in repo. So we've got collateral, we've got haircuts, and we've got something called rehypothecation. And we'll explain what that is. So to understand how repo can both stabilize and destabilize markets, we have to talk about three key concepts. Number one is collateral quality. Repo is only as safe as the collateral behind it. So top of the list clearly is going to be Treasuries, then agency MBS, then corporates, and so on and so forth. So that's the collateral piece of repo. Then you've got haircuts. So lenders don't usually lend 100 against 100 of collateral. They might lend 98 against 100 of Treasuries. That 2% is what they call the haircut. It's a safety margin. And so that's the other term, in the gist of it anyways. And then there is something called, rehypothecation. And this is collateral received in a repo, where it can often be reused in another repo down the chain. So the same treasury can support multiple loans, creating a collateral chain. So in good times, haircuts are low, collateral is accepted easily, and rehypothecation makes the system very liquid. But in bad times, haircuts rise, some collateral is really no longer accepted, and this is where you'll see the chains break, and liquidity, evaporate all of a sudden, and that's the shadow banking version of a run. So let's talk about bad times and how a repo crisis unfolds. Let's walk through it. So how things basically break. So imagine volatility spikes, asset prices fall, doubts rise about some collateral, say mortgage securities, like in 2007, 2008. Lenders in repo react by raising haircuts, refusing certain collateral, shortening the terms, or just pulling away entirely. So borrowers suddenly need more collateral, can't roll their funding, and are forced to sell assets quickly. So that forced selling is what pushes asset prices down further, which makes collateral look worse, and triggers more margin calls, and which just leads to more forced selling. And this is the collateral spiral that we mentioned in episode 8. So in this spiral, money is effectively destroyed because repo funding disappears and the money like liabilities vanish. It's not that cash literally disappears. It's that the balance sheet shrink. In the shadow money that funded them no longer exists. So I want to bring in 2008 and 2019 when repo broke. And this is a really short version of what I'd like to do, which is go into more detail, I should say. But here's the overview of 2007, 2008. Mortgage collateral became suspect. Haircuts blew out. Repo lenders pulled back from dealers relying on MBS. Investment banks lost funding and Lehman failed. And the Fed had to create special facilities to lend against collateral that nobody else wanted to touch. And again, there was way more to the picture that I will go into detail on a later episode, which will be really interesting. So that wasn't just a housing crisis. It was a repo crisis. Now, 2019, demand for cash suddenly spiked, partly due to a Treasury issuance and corporate tax payments. Repo rates shot up briefly over 8 to 10% in some trades, far above the Fed's target rate. The Fed intervened with overnight and term repo operations to restore control. That episode was smaller, but it showed clearly if repo breaks, the Fed must step in. So let's talk about the Fed now. We brought them up. So and let's talk about a new backstop, one of their new facilities. So in response to these stresses, the Fed eventually built something new. This is a standing repo facility. This is a permanent option for primary dealers and some banks to basically borrow cash against treasuries at a known rate. So the Fed turned itself into the ultimate repo counterparty. This means, this is important, in times of stress, when private repo markets freeze, dealers can take treasuries to the Fed and get reserves in return. This doesn't prevent all crises, but it gives the system a ceiling on repo rates, a safety valve for collaterals as well, and a clear signal that treasuries will remain liquid. It kind of formalizes the idea of the Fed as dealer of last resort. So why does this matter? Why repo matters for rates, valuations, and markets? And how does this connect back to us, to you? Because repo anchors short-term interest rates, influences the cost of leverage, affects demand for treasuries, shapes credit spreads, and ultimately feeds into discount rates that are used in the very valuation models that and so when repo is cheap and abundant, leverage is easy, the ability to take risk rises, of course, liquidity is strong, and there's this natural, way of valuations expanding. But when repo is expensive or scarce, leverage is painful. You retreat on taking risk. Liquidity is dry, and valuations, well, they contract. So when we talk about financial conditions, what we're really talking about is how easy is it to obtain funding in markets like repo. That's the bridge between money and finance. And again, understanding this of repo and what it is, and you can understand crises, why they happened. You can have clues to what's going on. And it can make the Fed's action also make more sense. Have this understanding of the connections between treasuries, funding, and valuations. And when you see that, it makes markets to start look like they're not as chaotic and more of like a machine with levers and gears. And that's what this show is about. And I want to thank you for listening to episode 9 of the Global Ledger. We opened up with the repo market, talked about the core funding engine that drives the shadow banking system, and where modern money is made and under stress destroyed. In episode 10, we're going to connect everything we've learned so far directly to valuation. And that's the discount rate, kind of where money meets finance in a way. So we'll take all this talk about liquidity and funding and risk and show you how it flows into the numbers you see in valuation models and of course, asset prices. So once again, I am Justin, and thanks for being here.